Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Most people think that property transactions only happen one way. The buyer gets a mortgage, the seller gets all their money on completion, and the deal is done. But in tighter markets, higher rate environments and more creative transactions are available. We're starting to see investors explore alternative ways of structuring deals, and this is a fantastic tool in the toolbox of a property investor. In this episode, I want to break down vendor finance, what it is, how it works, why some investors use it, and the risks and opportunities that come with this type of arrangement. What is vendor finance? Vendor finance is when the seller helps finance part of the purchase. Instead of the buyer paying 100% of the money up front, usually, if you bought a property in cash, you'd put 100% of the money in, or you'd use a mix of mortgage or bridging loan and cash, which would make up 100% of the purchase price. What happens on vendor finance is the seller agrees to defer part of the payment, leave some money in the deal, or receive payments over time. So the seller effectively becomes part of the finance solution. So the easiest way to think about this is the seller becomes the bank. So if you imagine a situation where a property, let's just keep it really simple, a property for 100,000, and the normal circumstances, you would get a 75% mortgage, for instance. So the bank would give you a loan of 75,000. You put in 25,000 of your own cash, which makes up 100,000. Both of those funds go to your solicitor prior to completion. On the day of the completion, that 100,000 is transferred to the seller, and in return, you get the keys. So how this would work, for instance, if you agreed a deal with a vendor and for the same purchase price, 100,000, you might be able to put down a £20,000 deposit, and you would give them 20,000, but agree to pay them the rest of the 80,000 at a time in the future. So what that means then, they would become bank. So they would put a charge on the property, generally for security, which we'll talk about more in a second. They would put a charge on the property, and you would owe them 80,000 as you would have if you'd owed the bank money on the mortgage. So they would take a charge. You would have probably agreed an interest because this is a commercial transaction, and you would have, agreed a rate. You'd have agreed a time frame to repay, how that payment would be. Obviously, on a mortgage, it's paid monthly, but you might agree to pay this monthly, quarterly, annually, or roll it up and pay it all at the end. So there's various ways you can do it, and because it's a commercial agreement between two parties, you can decide what that is. So this is a really, really useful tool to help you do more deals. Now, the key piece here, from a regulatory point of view, is this only works with unregulated transactions and not regulated transactions. So if you're buying a property that somebody's currently living in, or they have lived in it, or they've inherited that property, so it's either a residential property or consumer buy-to-let, this option it won't work, because the lender, in this instance, the seller or the vendor, is likely to be is not a regulated entity, and therefore can't lend against those types of properties. But if it's an investment property and they've never lived there and it's completely unregulated, then this can work and this can become a great deal. All right. So why would a seller want to do this? This is the bit that most people don't understand. So, options that would be harder market conditions. So maybe the property's been on the market for a while. They've got difficulty finding buyers for it. They might want to use tax planning. So they might want to structure the payments coming in over a period of years so that it's more tax efficient. The benefits of doing that have gone away a little bit with the reduction in allowances for capital gains and things, but that's on them to decide whether that's useful or not. It might be, and that's a conversation you can have with them. They might want a desire for ongoing income. Now, what we talked about in the first instance, and this is one of the key questions that you should ask when you're direct to vendor and speaking to people, is, what are your plans for the money? So if we go back to this example, if I bought a house off somebody for 100,000, the solicitor would transfer the 100,000 to them on the day of completion, and then they've got the money sat in the bank. So maybe they don't want the property anymore. They don't want the hassle of tenants, or they don't want to do a refurb or whatever it may be. So they just want the property problem gone. They don't actually need the cash. Now, if they say, I need the cash because I've got to pay off another mortgage that's coming to an end, or my daughter's getting married, or whatever it may be, I want to retire and I need to use that money, whatever it may be, part of that fact-finding mission helps you identify what their problem is that they're trying to solve and how you can help them on a creative basis. Now, if they say they're just going to put the money in the bank, they've got no use for it at the moment, it's just a property problem, then that's a great opportunity, because if they're just going to go and put the money in the bank, they're likely to just put that in a deposit account in the first instance, which obviously in the current climate is a pretty low interest rate. And therefore, you could propose lending the money off them. Effectively, they become like an investor in your deal, where you can agree a higher interest rate than they would if they get in the bank. So they get better income from that money. They get security over the property, and then you pay them an interest, and a loan agreement is drawn up between you. So there's a desire for ongoing income, and you can provide them with a better income than what they could if they just put the money in the bank. So it's like having property without having any of the stress. It might be used for unusual properties, so things that are not necessarily mortgageable in the current state. And also it can allow transactions to happen faster because there isn't a bank involved generally. So, flexibility creates a deal that otherwise wouldn't happen. And this is a fantastic tool, as I mentioned earlier, that as a property investor, armed with lots of different tools to see how you can make a deal work. A lot of investors may walk away from deals because they can't make them work. But if you know about this option, then this could potentially help you get more deals across the line. So what does it look like in practice? So I'll give an example of a property that we bought. I think we agreed, I think it was 140,000 for the property. It was a semi-commercial property, a shop with 3 flats above. There was a tenant in the shop, and the 3 flats above were in a poor state of repair, so they were unmortgageable. So the options that I had at that time was a bridging loan or some other creative options. So at the time, what we'd agreed, he was open to doing vendor finance, but there was a slight hiccup. He didn't own the property 100%. There was a mortgage on it. So this is where it became a little bit tricky. There was about a £40,000 mortgage on it. So what we agreed in this deal was we borrowed the money. We borrowed the 40,000 from another individual. We used that money as a deposit, which allowed the seller to clear their existing loan. So now the property was unencumbered. They then put a charge on the property, and the investor put a charge on the property. So the vendor had first charge, the investor had second charge, and then we agreed terms to repay. So we had a loan agreement, or 2 loan agreements in this example. So we had a loan agreement with the vendor. We already had income coming in from the shop, which would cover the interest from the vendor anyway, which was great. Then we did up the 3 flats, and then later on we refinanced on a long-term mortgage, semi-commercial mortgage, to pay off both the vendor and the investor on the second charge. So we had enough increase in value to pay off those both. So a fantastic deal, and it allows you to do those types of deals that maybe you wouldn't be able to do. It helped that the vendor was an experienced investor, so you understand the issues with the financing of it in its current state, and also is a bit more commercially minded on it. So we agreed to pay monthly interest on that one, which was fine. And because, like I said, the income was already there on the property. One of the things to consider is if there's most mortgage companies wouldn't allow this scenario where you'd have that. So vendor finance is rarely used with a mortgage. However, there are bridging lenders that will allow it. So some of the risks and considerations that you might want to think about. So vendor finance is not free money. It could be free money if you agree a 0% interest on the loan, but that's unlikely to do that. It's not an informal lending, it's not a handshake. You would want to do this properly, and it's not something that you would want to structure casually. So things to consider is you'd want to get legal advice, and you'd also want to get the vendor to get legal advice, because you'd set up a loan agreement. And within that, in the heads of terms, you want to know what the security is. So are they getting first charge, or are they getting second charge, or can you offer them some other security? What are the repayment terms? Is it interest only, or is it repayment? How are you paying that interest? Is it monthly, quarterly, annually, or rolling up at the end? What's the exit strategy? So they want to know that they're going to be repaid. How long is that? Is it a 1 year, a 6 month, 12 month, 3 years, 25 years? There's some deals that are done, and people have done them over a long term because they're happy with a long-term income, like we mentioned earlier. There might be existing lender restrictions. As I mentioned on the deal that we looked at, there was a lender in place, so we had to clear them out and as part of that transaction. And then the implications on valuation, how will the value stack up? And that part of the exit strategy, do you know that you're going to be able to exit with the right value in order to pay them off? So creative finance, like I mentioned, is a great tool, but you need to fully understand the pros and the cons and why it could work for both parties, but what also can go wrong. And you have to talk about all the things that can go wrong and hopefully get that into your agreement as well, so that both parties going in eyes wide open. So how do lenders view it? So some lenders are comfortable with it, but most of those would be on a short-term basis. This is the bridging and development finance options. As an example, we've done one with a deal with a land development where the developer agreed vendor finance on the land with the landowner. So the landowner basically sold the property to our client. So they then owned the property. And then the development finance provider took a first charge, and because effectively there was equity in the deal already, would loan the developer monies on day one, and then the seller of the land took a second charge on the land and was happy to receive his share from the profits at the end with interest. So it's almost like a JV, but the client is in control of the land, and the land is in their name. So the key thing about this, which is probably, if anyone's using some sort of creative finance or done some creative deals, it sounds like a purchase lease option, but it's not a purchase lease option. And that's the key difference here. With a purchase lease option, you have the opportunity, but not the obligation, to buy a property at a fixed price at some time in the future, whatever you agree. However, with this, you become the physical owner of the property. So once the property it's a purchase, it's transferred into your name. And so that timestamp, so obviously some people will know about the 6-month rule. Now, there's a lot of lenders that don't allow you to refinance within 6 months, but there some are, as long as you can prove that and how. So there's the timestamp of you owning the property. So once you've added value through a renovation or planning or whatever it is that you're going to do, you can refinance then, over that 6-month period. Once the 6 months is passed, you can refinance at a higher value. I'm not saying that the 6-month rule doesn't apply. We can do deals within that, but the majority of lenders, from a refinance perspective, will want to see ownership for more than 6 months. If you want to know more about that, then just get in touch. So like I mentioned, some lenders will allow a deferred consideration. Others are happy with vendor loans, and more happy if, from a vendor loan perspective, second charges. Most lenders, pretty much all lenders, will want first charge. That's in the bridging space. There are some bridging companies that won't allow that to happen. And from a mortgage perspective, you will struggle to find a mortgage company that'll be happy with any sort of deferred consideration or vendor loans. So yeah, this is more based on the short-term space. And this is why you need to use a broker who understands both long-term mortgages as an option, residential and buy-to-let, and also short-term finance through bridging and development finance, because I know lots of brokers who don't even understand what vendor finance is. So they can't even have that conversation with you as part of the tool. And a number of times we've suggested this to clients who have gone away, done deals on the back of it, and they've saved thousands in various fees and things, and actually being able to make a deal work. Because sometimes, when you take bridging, there are fees involved, and that can be restrictive enough not to make a deal work. Whereas with this, maybe you can. So yeah, it's a great tool in your toolbox, effectively. So things to think about with a lender, have to be transparent. You can't try and hide this from lenders, because it will come out in the wash, and it'll stump you at a later date, and you will cost you fees. Loan to value restrictions, what the repayment structure is, who has first charge security. Like I mentioned, lenders want that. And not all vendor finance structures are mortgage friendly. So you really do need to make sure you're dealing with someone who understands this. So when can vendor finance work well? So this is best used for mainly for experienced investors who understand the various dynamics and options available to them. Semi-commercial deals, like I mentioned, perfect for that type of scenario. Any deals where you're going to add value, so like your BRR deals, you can use this to add value and then refinance to pay back the investor. Slower moving stock or portfolio transactions or bigger transactions, and where you've got a good relationship with the vendor, they can understand how they can help you get a deal over the line. Because most investors are commercially minded. Once they've been in the game for a long time, they can understand the pros and cons of doing various transactions. And a couple of the ones that we've done have all been with experienced investors, because they just understand it and how it works. This strategy is used a lot in America, but it's used a lot in business transactions and business purchases, M&A deals, but not so common in the UK mortgage market or UK property market. So, both parties need to be commercially aligned, and there needs to be a good relationship. You need to make sure you have legal advice on both sides, and there's a realistic exit to get the vendor their money back. So one of the biggest investor mistakes that investors make, so it's not no money down. There's money down. It's just maybe not your money. And creative finance is not low risk. So whenever there's any complexity, things can happen. You need to make sure that risk is managed well. So, sometimes the more creative the structure, the more important the planning becomes. You want to make sure that all your ducks in a row, and making sure you've got the right professionals with you working on, the right solicitor who understands this stuff, and also the right broker. And even though on a vendor finance deal, a broker wouldn't be involved in the front end, you want to make sure that your back end exit, your refinance, if you're not selling the property, then that would work. Hopefully that's been helpful. Vendor finance is a tool and not a shortcut, and used properly can unlock some opportunities that you may have overlooked, create flexibility, and they help deals happen. If it's used badly, it creates confusion, additional risk that's not needed, and poor exits. So hopefully that's been helpful. Vendor finance is becoming a bigger conversation in property because markets evolve. Investors are increasingly needing flexibility, creativity, to make structures and deals work. But with all the finance strategies, the key isn't just getting into the deal, it's understanding the long-term implications and making sure the structure actually supports the outcome you're trying to achieve. If you're exploring a deal involving vendor finance, deferred payments, or more complex structures, it's worth having those conversations early, because creative deals need clear planning. Thanks for listening. Hope you enjoyed, and we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.